Okay, let me start off. Hey, good afternoon or morning or evening, whatever time zone you are all in at the moment. It's afternoon here in the UAE. I'm Nick Spencer-Skeen. I'm the Senior Executive Officer of Lunaro Markets Limited in the Abu Dhabi Global Markets with CADGM, and we are a regulated firm by the FSRA. I'm also a Director of Lunaro Financial Services Limited in the UK, which is an FCA regulated entity. I'd like you to welcome to our first in this new series of webinars and introduce our host today, Alex Mahoney. So Alex is the head of macro trading strategy at Alpha Picks, a cross-asset investment team. They provide easily digestible institutional level research and trade ideas to their 10,000 plus subscribers, who include institutions, corporates and retail clients. So Alex has previously spent 7 years at Citi, where he served as an FX sales trader. So he also holds a master's in finance degree from the University of London, alongside his investment advice diploma from the Chartered Institute of Securities and Investments. So I'm going to hand straight over to Alex now, and we do have a Q&A at the end. So obviously, people can post their questions up. We'll try and make sure we give Alex enough time to respond to as many of you as possible. So over to you, Alex. Thank you very much.
Brilliant. Thanks, Nick. And warm welcome, everybody, regardless of where you are in the world. So a really interesting topic of conversation that we're going to be talking about today, and that is event risk. How to trade the market when everyone is watching. Now, this is a particularly relevant topic at the moment because we have seen heightened volatility associated with recent events, be it from a geopolitical level through to a macro data level or even a central bank level. So today we want to sort of look at three main areas which actually run through quite nicely in chronological order. So first of all, we want to look at how do we identify a tradable event? How do we then map the product that we want to trade? And then three, look at some takeaways when looking to trade and then exit any potential position after the event. So to begin with, let's have a look at identifying the event. Now, this is a really interesting point because it isn't simply a blanket statement to say that any event that could trigger a market reaction is worth trading. But before we get to understanding the answer to why that is the case, let's just explain a few of the events that we're talking about. So I put together a little table here of some of the different types of events that traders can potentially look at. So if you look at the different catalyst types, so the first one of the largest ones, is macro data. So what are we talking about here? Well, we're talking about things such as inflation releases. So CPI, Consumer Price Index, is one of the most popular ones. You have other specific ones for different countries. For example, in the US, the Fed's preferred inflation gauge at the minute is core PCE, core price consumption expenditures. And so that's one that's focused on in the States. But every country will have their particular measure of inflation, which typically gets released once a month as a percentage of the change year over year or month over month, which investors need to digest. Payrolls is another one. So we can think of this as an employment report that comes out, again, typically on a monthly basis. PMIs, the Purchasing Managers Index, is one that looks at the state of an economy from a manufacturing or a services perspective. And those are just a few examples of macroeconomic data that come out at a set time each month or each quarter, which can provide a tradable event. Another one is central banks, and this is certainly a popular one. So again, typically once a month, certainly several times a year, the central bank from any major nation will come out, they'll have their own internal meeting, and they will come out and announce the policy decision that they've come to with respect to monetary policy. So the main factor here that a lot of people dwell on is obviously the interest rate of that country and the decision that's gone along with that. Have the committee decided to raise rates, to lower rates, keep them unchanged? But also an increasingly important part is not just the headline move, but also the guidance. So has the central bank come out and said, we're not raising rates, but our guidance is we're concerned about inflation, we're concerned about the state of the economy, and so this may see us in the future do X or do Y. So the guidance that a central bank gives as part of that public meeting is also market moving. And then even things that are specific to some central banks. So mention the dots there. So the dot plot, which is sort of made famous by the US Federal Reserve, is a plot and a chart of where the different committee members see interest rates going over the course of the next year, 2 years, 3 years. And markets can then look when the central bank meets and the updated dot plot is put out and say, okay, this is the updated forecast of interest rates from their members. How does that stack up to what current interest rate futures are pricing? Another one is politics and policy. So some of these are very time-stamped events. So we think of elections as being a good example here of a set time and a date where an election result will come out, and potentially we have a change of leadership or a change of government in that country. But we can have other political events that are time-stamped. If I mention tariffs, for example, certainly I imagine that the US, the Liberation Day in early April, when Trump came out and announced a wide range of sweeping tariffs around the world, that was a time-stamped political event that markets had to react to. Aside from the sort of macro level events, there's also some more specific ones for asset classes, corporate events. So typically each quarter, a public company will release their earnings reports. And obviously, even though that's released pre-market open or post-market close, the report still triggers typically a move in that underlying stock price that's then reflected on the next trading day. If I talk about the SpaceX IPO, which has been a very popular one for retail and institutional investors recently, when the company does go live, that's a big corporate event that triggers volatility. And then other ones I've mentioned there, the market structure. Each quarter you get an index rebalancing. You have companies that move out, companies that get promoted, and the change in ETFs as certain stocks get dropped and certain stocks get bought from an index rebalancing. And even geopolitics can have a place. So as you can see from this, there's a wide range of events that we're looking at as traders in order to understand if there's a potential trade to be had, and what specifically can trigger that. And although we'll come on to it a little bit later, I've put a little column there of likely market expressions. And this is something that is really important that we'll come on to later, in that depending on what the event is that we're looking at, the cleanest expression of trading that view is likely going to be a specific asset. So just an example here, corporate events. If we have a corporate event, a company earnings, the cleanest expression of that is obviously the company's stock or an option on that stock. If we're looking at central banks and monetary policy, interest rate futures, again, are likely going to be the cleanest expression. So that's a really good point for us to consider as we go through this deck. So we've got a big list of events, loads of different things that cover it. And now we want to start to filter down for what events are actually tradable. So we have a few bullet points here that can help us to assess if an event is tradable or not. The first one is a fixed timestamp. Now, obviously, for an event to be tradable, we need to know when it's going to happen and when the outcome's going to be released to the market. So there are some events that you can't anticipate. But for a trader, we really want to have an event in the diary that we know when something's going to come out and happen, because that's when the market is going to react. Now, the next couple of points go hand in hand, relating to how dispersed the outcomes are and what expectations are built in for a particular event. Because if we have an event where expectations are fairly priced, or that there is limited outcomes in terms of what can happen from the event, then again, there's not really much of an edge to be had in committing capital to a trade in that case. Really, we want a case where there's a wide range of outcomes that could happen from the event, and expectations are not priced too far either way. Now, I do put a little asterisk next to price expectations because every once in a while, you can have a situation, let's say with a central bank, where the vast majority of people expect, for example, a rate hike. And you might have the futures markets and the currency markets pricing in, almost 100% probability that this central bank will hike on this day. Now, 1 in 100 in those cases, maybe the central bank don't hike. And obviously you see a large outsized move as a product of that. So certainly, expectations do need to be taken a little bit carefully, but the overarching theme is that if something is very heavily priced and you agree with that view, then there's little juice to be taken out of the markets there. Now, crowded positioning is a good one. It sort of ties in a little bit with what we've spoken about, but if the market is positioned one way, and the outcome isn't according to how the market's positioned, then you will likely see a larger move the other way versus if positioning was sort of net neutral going into an event. So looking at positioning is a really interesting one. And sometimes when it's tied in with a view, crowded positioning can actually be a factor that can make a trade, an event tradable. Transmission path, we've alluded to this before, but you have to have a tradable financial product to be able to express your view. So you may have an event that you have a particular view on, but if there's not a clear way for you to actively trade that in financial markets, it's simply not a tradable event. And then lastly, which is arguably one of the most important points, having a view. Now, an event simply isn't tradable if you don't have a view on what's going to happen. Now, there's no problem on you not having a view or having a neutral view, because you might look at a macro data release that's coming up, or an election outcome, and you might think, do you know what, I don't have a clear view, I don't have a bias on what's going to happen. Well, it's not a tradable event. But if you do have a firm conviction or a view, along with some of these other factors, well, then you can really build into an event. So just as a couple of examples of what we're talking about here in real life. So this is a trading example of where there wasn't really a tradable event. So this was the Bank of England meeting from a couple of weeks ago. And the chart you're seeing here is the interest rate futures chart for December of 2026. So this chart essentially helps to show where markets think the UK interest rates will be at the end of the year. Now, what we've seen here, if you look at the spike in the chart around the sort of middle of June, you saw that traders were pricing in a less hawkish stance from the Bank of England, i.e. they weren't looking for as many rate hikes as was currently being priced, and they actually thought markets would ease pricing a little bit. That's why you saw that move higher from the 11th of June onwards. Now, at the Bank of England meeting, which is where the little highlighted circle is, the Bank of England effectively confirmed the view of the markets. They didn't hike interest rates, and they sat in a pretty neutral tone. Now, because markets have already factored this in, you saw the move over the course of the past week or so. When the markets had confirmation that their view was correct, there wasn't really any particular move in the interest rate futures. So this is a good case of where really we had a tradable event, but there wasn't, particularly expectations of a large move, dispersed outcomes, etc. And so there wasn't a trade here. In contrast, the Federal Reserve meeting from June certainly did provide a trading opportunity. Now, if you have a look here on this chart, this is the corresponding interest rate futures chart for December 2026 for the US. Now, what you'll notice here is in the white chart where I've circled it, this was the employment report, non-farm payrolls, from the beginning of June. And what we saw here was a very strong employment report. The headline non-farm payrolls print was 172K. It was over double what the market was expecting, essentially pointing to the fact the labor market in the US is fine, it's strong, there's not a problem there. So we saw a move lower in the interest rate futures chart, which effectively corresponds to traders thinking the Fed would have to pivot to a more hawkish stance at their upcoming meeting. So let's say we had that confirmation and we were then looking at a trade a couple of days before the Fed's meeting, and we said, okay, well, look, the labor market's strong. We know that. Inflation is still running hot in the US. Therefore, I have a view that the Fed are going to have to pivot to a more hawkish stance in their upcoming meeting. Now, in that case, it ticks a lot of the boxes. You have a time-stamped event. We know when the Fed's meeting going to be. We have a view because we've seen employment data. And going into this event, it was still, the outcomes were fairly 50-50. The market wasn't quite sure if the Fed were going to sit on their hands, be neutral, or actually see the fact that, yes, we need to indicate to the market we might need to raise interest rates this year. And what happened? Well, the Fed meeting came. The new chair, Walsh, was hawkish in his comments. And as you can see, the futures contract moved lower, effectively corresponding to pricing more hikes from the Fed this year. So that's a good example of where there was a tradable event based on the different factors. Now, the second point we want to look at is mapping the product. So we've seen events, we've seen how we can trade them, which events are tradable. But now the next point, as we've alluded to earlier, is, well, how do we translate that into a product? Now, really, in my perspective, there are three ways to trade on the products. Taking a direction, an outright view, having a relative trade, we'll look at what that means, and finally being sort of direction agnostic, but wanting to make a play on volatility. So let's take the first one, a directional trade. And this is the same chart we looked at a few minutes ago of the Fed's meeting with interest rate futures. So in this case, we were in that position where we'd seen a strong employment report, we'd seen inflation was remaining elevated in the US, and we thought, okay, I think the Fed's going to be more hawkish than anticipated at their upcoming meeting. Now, the simplest trade in this case is just to take a directional view. And what we mean by this is you're either going to go long or short a particular contract or a financial instrument and take that view. Now, the pro of taking a directional view is that you do get a clean expression and you do get the full extent of any move if it goes in your favor. Now, the con to taking a directional move is you are completely exposed if the market goes against you. But in terms of the cleanest way of expressing a view from an event, an outright view, being simply long or short without any hedges associated with it, gives you the full benefit of whatever move might come from that. So in this case, for the interest rate futures contract, we would have shorted the contract to aim to benefit from our view. Now, the second case is having a relative trade. Some people talk about this as spread trades, some talk about this as partial hedges, but really all we're talking about here is we're taking a view that has more than one leg or more than one position. So a good example here is the chart of sterling dollar that we have in this case. Now, this is one where you might have been in a position where you looked at both the Bank of England and the Fed meetings, which happened broadly at the same time. And you might have said, okay, do you know what? I agree with the view of the Bank of England not looking to raise interest rates. I agree with the view that I think the Fed will sound more hawkish to increase interest rates. Therefore, I'm going to take a relative position on where I'm going to sell sterling and buy dollars. And I think that over the course of the next few days, the market will move lower. Now, why would this be a relative view? Well, because one of the elements that influences a currency pair is the interest rate differentials between two currencies. Simply put, if I can earn more by sitting in US dollars than I can in sterling, that positive differential will mean that you can see flow move out of sterling and into US dollars to benefit from that respective move. And therefore, you see sterling sold, dollar bought, and the market move lower. Now, what did we see? Well, we saw that as the case. The Bank of England gave guidance they weren't particularly looking to hike aggressively. The Fed were contrasted to that. So at a relative level, the dollar was more appealing to traders than sterling was over the course of those few days. And if you have a look at the white rectangle that's highlighted, we did see that. We saw sterling dollar move lower. First move lower was after the Bank of England meeting. Second move lower was after the Federal Reserve meeting. So this is a really nice way to express the view if you don't want to take outright directional exposure. So in some ways, a relative trade, it can be assigned to be lower risk, but that you can still feel the benefit from taking a view around an event. Now, the other benefit of relative trades is that you can also tie in multiple views. So obviously we've tied in here the Bank of England as an event and the Fed as an event. And really currencies is a really nice way where you can express a view of two countries and two events, be it inflation in the Eurozone and inflation in the UK, interest rates in the US relative to interest rates in Japan, even things such as political uncertainty. You could say, okay, I think there's heightened uncertainty in Mexico or somewhere in Latin America versus somewhere that's very stable in Switzerland, for example, and make relative plays that are not outright on a particular country or an event, but can still give you room to profit. Now, the final example is volatility. Now, we have actually got an upcoming webinar completely devoted to volatility, how to trade it, what it is. So certainly come and join us back for that one. But really, in the case we're talking about it today, we could have an event. We'll stick with the Fed meeting from June. And you might have gone into that and said, yes, there are dispersed outcomes. There's expectations one way or the other. There's not a clear bias. But I don't really know which way the Fed's going to go. Are they going to pivot and say, we're going to stick as we are, or even slightly dovish? Or are they going to pivot to be hawkish? I don't know, but either way, I think there's going to be a big reaction in the markets based on the fact of, I think they're going to have to pivot one way or the other. So in that case, you could look to trade a product such as the VIX, which is the volatility gauge for the S&P, but certainly that translates to a broader market volatility index for other assets as well. And as you've seen in the white rectangle again, this is the period over the immediate aftermath of the Federal Reserve meeting. And you can see the volatility clearly spiked after the meeting happened in the immediate aftermath. So in this case, you could have said, okay, I think there's going to be a big move. I don't know which way it's going to go, but I'm confident there will be a move. Therefore, I'm effectively going to buy volatility over this event and try to profit from a volatile move. And this can work the other way as well. You can be in a position where you think, actually, I think nothing is going to happen here, nothing interesting, and therefore look to sell volatility into the event. But this is really a case, unlike the other two cases, where you are taking a directional view. When you're trading volatility, you're not trading a particular direction of the asset. You merely think it's going to be volatile one way or the other. So in terms of sort of summarizing this bit, is that we really want to try and answer the question, what is the product most directly linked to the repricing variable? So for a central bank meeting, the repricing variable is in most cases interest rates. So what product is most directly linked to interest rates in that case? I'd argue interest rate futures, followed by foreign exchange, followed by the equity market in that country. So really, it's mapping that transmission chain of saying we've got the event, we filter it to be tradable, we have our view, and then we pick the transmission chain as we've looked at over the different stages, directionally, at a relative level, or volatility, and there we can pick our product and therefore have our trade set up ready to go. Now, the final point we want to run through is the trading takeaways and really trying to bring everything together here. Now, when we look to take all of that information we've just looked at and build a trade behind it, there are a few extra additional points that we need to bear in mind. The first one is a defined time horizon. So when we're looking at having a trade, how long do we want to be in the trade for? When do we want to enter it? When do we want to exit it? Because there's no point, you might have a view on the following Fed meeting, which isn't for weeks and weeks. Now, would it make sense to put a trade on now for that Fed meeting in the future? Well, the answer is not really, because it's too far away and there are too many variables between now and then that could move markets, various events, before we actually get to the actual event you're trying to trade. So really, when we look at isolating an event, ideally we only want to be adding positions a few hours, maybe a day before the actual event happens, because we don't want to restrict ourselves on being prematurely stopped out because of an event that happens before we reach the one we're focused on. Now, position sizing is also really important because as a general rule of thumb, when you're trading in general, when the markets are volatile, when there's a lot of stuff going on, you want to reduce the size of your positions to avoid excessive losses from being on the wrong side of the market. And an event has short-term volatility. That's exactly why we're trying to trade it. So we want to reduce our position size whenever we're trading around events because of the added risk associated with it. And the final point we'll look at is entries and exits. Now, when you're trading an event, you are likely going to see sharp two-way moves. And if I go back to the VIX trade, this is a good example here. So, for example, let's say you were interested in buying the VIX ahead of the event. Well, you notice in the very immediate aftermath, we actually saw the VIX move lower before it then spiked. And then it came off again before spiking and peaking and then retracing. So if we put a really tight stop on our long VIX position, there's a chance we might have been stopped out before we even saw the market be able to move in our favor. So because we're reducing our position sizes when trading around events, we can afford to have stops placed wider than perhaps we normally would. And that gives it time for the market to appreciate the volatility, but also to see a move in our favor. But also, as you'll notice from this chart and from the others ones, picking a top of where we want to get out can also be quite difficult because of the volatility. So although you want to go into a trade and have clearly defined risk and reward parameters, certainly watching for your take profit level over these sort of events, if you are in them for a short period of time, is worth looking at them manually because it may be a case that you have to readjust based on the situation you deal with after the event comes out. And finally, just wanted to talk about the aftermath phases of an event, because I know obviously there's a variety of different traders on this call in terms of some that will want to trade over the space of 10, 15 minutes. There are some traders who their time frame is a few hours, and then some that trade over the period of several days or more. Now, when we're just talking about trading events, the three categories I've mentioned here are the ones that tend to fall into. So you tend to have the first move in the first 15 minutes after a data release. And this is where the concentrated buying or selling activity happens, and you tend to see a clear direction as to whether the market's taking this well or badly, and you see that move. Then over the course of the following hour or two, that's when the initial digestion period happens. So a central bank meeting is a good example. In the first few minutes, you'll probably get a whipsaw reaction based on the interest rate decision, any QE or any other packages that are announced. And then over the course of the next couple of hours, as we get the press conference, we get opinions, we get the market to digest what this actually means, that's when you see the second move that comes through. And that can be a continuation of what we've already seen, or it can, in some cases, reverse that initial move. Then the final one is the initial days. So this is one where you tend to see slower money move into the market once they've digested and really looked over what happened over the event, how the market took it. You then see the fast money having been in and out, the more slower money, the real money from pension funds and other asset managers can then look to come in. So depending on your time scale, depending on how much risk you want to carry, depending how comfortable you feel being in a trade over a few hours or overnight in some cases, will determine how long you have to go in for. There's no right or wrong answer on how long you should trade in events, and it really depends on your own personal preferences. So hopefully that's given you a good overview of what we wanted to talk about today. So really, in summary, we want to take events, not all of them are tradable. We want to filter down into the events that we have, the ones we have a view on, the ones where outcomes are dispersed enough to see a market reaction. And then we want to say, okay, well, how do I want to trade this event? What product is the right one for this case? And then, as we saw in the last part, we then want to look at setting up our trade, our entries, our exits, and how long we want to be involved in it. So at that point, I'll hand back to Nick, and we'll open it up for any questions.
Thanks, Alex. It's really interesting. Look, I've got a few questions in there already. First one is, could someone have a strategy to trade only around events?
Sure. So event-driven strategies can be used. There are funds out there, and certainly even individual traders that just look to trade around events because they are a source of market movement and volatility, so they can be taken advantage of. The only thing I would stress for those that are just looking to trade events is that they are typically higher risk of tradable opportunities by nature. So there are cases where other trading strategies, maybe sort of momentum trading or trend trading, those are slightly lower risk, potentially lower reward, but lower risk. So I would say, even though you can just trade events, I would say it's better to sort of blend in event trading along with other strategies to sort of reduce overall risk.
Okay, what are some big events on the horizon for the coming weeks that people should be maybe looking out for and watching?
Yeah, that's a good question. So I'd say the one that definitely comes to mind for this week is US non-farm payrolls, the employment report. Always comes out on the first Friday of every month, so it's easy to track. This month, it's obviously Independence Day, so on Friday, a lot of the US markets are closed. So for this instance, we get it tomorrow on Thursday. So I'd say that's definitely the most immediate one that people can look at. And certainly from this presentation, take and go through the steps we've looked at and in their own view, see if that's a tradable opportunity or not. But yeah, I'd say that's the one that definitely springs to mind.
Just on that one, we do actually put out an events calendar beginning of every week. So if people are interested in what events are coming up, check on our LinkedIn or other social media channels, because we do post them all out there so people can see what is coming up on the current week. So for someone who isn't experienced in trading multiple asset classes that you've mentioned, is there one asset class that will move based on most major events?
Yeah, so I think it depends on what people are comfortable trading. I think that if we put it on its head, there are some assets that tend to move less than others depending on the action. So, if we're talking about a central bank decision, some of the corn futures or coffee futures are unlikely going to move much in the response to that. So certainly there are some products that can be discounted. As a general rule, if people are just happy with one asset class, let's take equity markets, for example. The stock markets are a good barometer for the health of any economy. So if someone just felt comfortable trading equities, for example, certainly that can offer trading opportunities for everyone. think, for example, on an interest rate decision from a central bank. If a country is looking to increase interest rates, that's typically negative for the stock market because companies will face higher financing costs as a result of it, and vice versa for lower interest rates. So certainly you can look to express a view just from the market you're comfortable trading, but there are cleaner expressions if you are happy to trade multiple different assets.
Okay. How about if I already own a stock that's about to report its earnings? How can I best protect myself?
Sure. So we didn't actually talk too much about corporate earnings or event risk on a company side. But yeah, there are two ways to look at it. So one is if you don't own the stock, you can take a speculative view on the outcome of a corporate event. If you already own the stock and you're going into a risk event like earnings, the case there is more looking at potentially looking to hedge yourself. And that really, again, depends on the view you have. So if you own a stock, chances are you own it because you think the company is doing well. So if you're going into an earnings call and from what you've seen from their trading updates since their last report, you think that the report is going to be strong and everything's looking fine, then in that case, maybe the best course of action is not to do anything. You own the underlying, you're happy with your position, and obviously you see how that earnings report comes out. If you do want to hedge it, if you think, actually, I think in the short term, earnings could be bad, or simply the benchmark for earnings is too high and it won't live up to expectations, then in those cases, you can take out put options on the stock, buy some short-dated options on that front, which essentially will profit if the market does fall, if the stock does fall. And really, that's a case of looking at covering your exposure. And then obviously, if it doesn't go your way, and if the market does take things well, you've lost your premium, but certainly you've protected yourself. So I would say those are the two main scenarios of what traders would do if they own the underlying stock.
Hang on. Just some of the numbers just popped up. What is the main differentiating trait that influences a trader's time horizon?
Sure. So I'd say one of the ones is the position sizing. So if you're looking to trade over a shorter time period, and you're looking to trade with a larger position size, that's certainly a factor to bear in mind on that front. So it's essentially marrying up, okay, well, do I want to have this size of exposure over a long period of time or over a short period of time? And depending on each trader's risk tolerance, that will sort of factor into that. The other thing that comes into deciding on your position size is also the size of your conviction or of your view. So, you might go into an event where you think, actually, I have this view, I think this is going to happen, etc. And you may have that view and be confident of that view and take a position size based on that. But also you may be in a position where they do come along and you can have really high levels of conviction of a certain event, in which case you'll be happy to increase your position size. So I'd say one is your time frame you want to be in on. The second is the level of conviction you have of your view being correct. And they would be the two main factors I'd point
to. That seems to be it in terms of questions that we have for this particular topic. So, hang on, another one's just come in. How about risk management considerations for position sizing during announcements? Thank you, Chad.
Yeah, so if we're talking risk management, I always go back to the percentage of your portfolio or of your book that you're looking to risk on a trade. So typically, 1%, 2% of your capital allocation to any particular trade. If you have very high convictions, you can increase that. But typically, in terms of good risk management, trading over an event is exactly the same way as I would treat any macro trade that I'm putting on. Even if it's a long-term buy and hold, I'd still, from a risk management perspective, only allocates 1-2% to an event-driven trade. Now, obviously, the difference between an event-driven trade and, let's say, a long-term buy and hold equity is the time horizon. One will realize my profit and loss in the space of a few hours. The other will realize my profit and loss over the course of 6 months, 12 months, or longer. But essentially, I only want to risk the same amount of my capital on that short event as I would on my long-term buy and hold. And the way I can manage that risk is really just looking at the percentage of allocation I put to it. I put to it in my book.
Okay, I've got a final question, which actually may also come into your future webinar about volatility. But can having exposure in the VIX be a hedge? If yes, how would you work out the P&L?
Yeah, that's a good point. So yes, definitely you can use the VIX as a hedge. The VIX acts as a better hedge when we're talking about the transmission channel and what's the cleanest expression. The VIX works better, given it's based on the S&P 500. It works better as an expression for events that impact the equity markets in particular versus some other ones. So certainly when we're talking about macro data releases, the VIX can be used as a good hedge there. With central bank meetings also it can be used. When we start to move away to more sort of niche events, maybe there are better hedges involved. For example, you can use options on different products as hedges. Again, we're talking about corporate earnings. Is the VIX a good way to hedge against individual company earnings? Well, unless you're a mammoth company like Nvidia, which does actually move the index itself, if you're talking about a smaller market cap stock, a better way to hedge is using an individual stock option versus the VIX at an index level. And in terms of how you would manage your P&L, so effectively you'd be trading future contracts on the VIX. And so based on the futures contract, the size of that contract, the minimum tick size, that's again how you'd work out your cash P&L. And again, you take your overall capital size, your trading book size, and from that, based on the VIX future and the P&L based on the tick side, you can then say, okay, I only need to buy one contract or two contracts of the VIX in order to get my 1%, 2% allocation that I want to risk on this trade.
Wonderful. I think we have now run out of questions, Alex. So obviously, thank you very, very much. Obviously, we'll put details out of the next one during, across the normal channels. Let everybody know about it. I believe it's scheduled for the 5th of August. So make a note in your calendars now, and hopefully we'll see you all back in just over a month's time. And for now, have a wonderful rest of your day. Thank you once again, Alex, and we'll see you all again at the second one in the series.
Pleasure. Thank you very much.
Thanks, everyone.